Welcome to the LiveSquawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary. Before we go into that, just to give you a quick heads up for those new to who we are, LiveSquawk News is an audio news service. We're a financial market news broadcaster, and we bring salient and up to the second content news headlines regarding anything financial in the markets, geopolitical stories as well, and data in terms of economic data from G7 and the wider G20. We've been going back 20 years, and part of what we want to try and do is make the world of trading and investing a little bit easier for you guys out there, and bring you guests and previews and just little data pops so you can get a better grasp of what's happening and what's going on in the markets, whatever it is you trade, whatever asset class you look at. Anyway, that's us over. If you want to trial the service, if you go to livesquawk.com, and you can get a free trial of the service. I think it's about a week, sometimes 2 weeks, if we're feeling generous, and just see what we do and see if it's something that might help your trading day or your investing. So that's that bit out of the way. Today we're going to take a look at the impending Q3 earnings season, and to try and help navigate what can be a busy and volatile time for stock indices and single stock traders. To help guide us through, I'm joined by Wall Street Horizon's Christine Short. I'll give her full title, Head of Research at Global Corporate Events at Wall Street Horizon, which is a TMX company. So at this point, I'd like to introduce Christine. Hello, Christine. How are you?
Yes. Hi, Harry. I'm great. Thank you so much for having me.
Also, no, thank you very much for agreeing to take part in today's show. I call it a show. Is it a show? No, not really. It's not that entertaining, but
sure.
We try and be educational, put it that way. Christine, as you may have heard from the intro there, we're looking at the Q3 earnings season, which should kick off any time now. And we want to just give a little bit of, we brought you on because you'll be your perfect sort of guest to sort of walk us through what to look for and what's expected from the third quarter numbers, as I said, coming up this season. Just a couple of questions to start with. When exactly does the earnings season start?
Well, technically we're in it because we've had a few companies report. We've had Nike, we've had ConAgra. I'm talking specifically S&P 500 companies, but the unofficial kickoff to the season when things really get going, it starts with the big banks, the 6 big U.S. banks, which for the Q3 season begins next Friday, October 11th. We've got JP Morgan, Citigroup, and Wells Fargo. And then it usually continues into the next week, which we would see the investment banks, Morgan Stanley, Goldman Sachs, Bank of America, and then a slew of other smaller financial names from the S&P 500. But we always say the unofficial kickoff is when JP Morgan begins. And for this season, that's next Friday, October 11th.
Awesome. Thank you very much for that. Here's that one up. And so leading into maybe we don't need to start with the banks, but generally, what's the general feeling that you think in terms of expectations about how corporate earnings will fare this quarter?
Yeah, so currently the expectations are for S&P 500 growth of just shy of 5%. That's both top and bottom line. If we get that for the top or for the bottom line, that would be the 5th consecutive quarter of positive growth. That's, of course, after in the wake of COVID-19 pandemic, we did have several down quarters. So we're continuing on, positive growth trajectory, although that's about half of what we saw in the second quarter. So we are down, but still positive expectations. And I have to say, analysts have really been ratcheting down those estimates a bit, which is normal. Every time we get into an earnings season, companies issue their own guidance, which tends to be quite conservative, right? Because they want analysts to pull their estimates back so that when they do report, everyone's surprised, there's a pop in the stock. So it's this cycle that anyone that follows earnings becomes very familiar with. What was interesting is leading into the Q2 season that we just ended, analysts didn't really touch their estimates. They only pulled them down about 0.5%, which was historically very low. Typically, we see them come down by like 3%. And so by not pulling them down, while we still saw like 80% of the S&P 500 beating EPS expectations, they didn't do so by very much, maybe a penny or two for some of these names. And investors didn't seem to like that. They didn't respond very well to companies that showed positive earnings surprises. They rewarded them less than usual. And then on the other side, negative surprises, they actually punished more than usual. So I actually think by analysts ratcheting down estimates, I think they've done so by about 3.5% since July, setting up to be actually a very good earnings season as far as beats are considered. It's a good catalyst for better earnings and revenue beats for Q3, and that one that investors respond more favorably to. So I think you might see a little more stock market movement around this earnings season than you did last earnings season, which is, could be a good thing.
So again, so how preemptive do you think the markets have taken for the indices, for example, preemptively? Do you think we've seen a bit more? Listen, we'll get into the geopolitical issues and the risks around equities in a short bit. But do you think there's been any preemptive bidding into this earnings season based on your theory?
Yeah, I think at this point, we're a week out from the earnings season beginning, so this should all be priced in. But like you said, it's pretty mucked up now by other things that are going on, specifically tensions in the Middle East. We've seen oil prices spike up a bit here. Crude's up about 5%. Also on the home front, we have I'm based in New York. East Coast ports are down for the third day in a row. JP Morgan has estimated that is costing U.S. economy $5 billion per day. That's 6% of U.S. GDP. So you're seeing a lot of that factored into the markets today. Markets are down. It's Thursday. Markets are down today. And I think we're kind of in wait and see mode to see what happens tomorrow morning. We get a big jobs report for September that could potentially loosen things up. So you're getting a lot of things in here today that's impacting stocks. Next week, I think more investors will turn their attention towards earnings. But as far as the 5% growth expectation, that's probably already been priced in there.
So you don't see a lot of wiggle room in terms of them moving that around based on these short-term factors. Obviously, I guess that the calculations have been done based on the company and themselves and their company performance, and so that's fairly set in stone in terms of what we might see currently in terms of the risks that we're seeing at the moment. And that would it be right to say that probably would feed into Q4 and beyond in terms of performance?
Yeah, well, what I'll say is that 5% is definitely not set in stone because I mentioned that analysts have ratcheted down. We tend to see that number will grow, right? Because 80% of companies will all act like we're surprised about it, but we'll probably see closer to 8% growth for the third quarter. As far as looking ahead, Q4 estimates have come down just a little bit, but still expected to be positive. Q1 estimates for 2025 have been pulled back. We're actually seeing Q2 2025 estimates were boosted just a little bit. So the further you get out, the more positive the estimates are. As you get into an earnings season, they tend to dip. But again, I always tack on 3% because I assume most companies are going to be, and historically what we've seen is the growth rate you've got at the beginning of the season, like around the time the banks are reporting, tends to go up by 3% by the time all of the names in the S&P 500 have reported.
Okay, thank you. It's good to know. In terms of you brushed on forecast there, will there be a lot of attention, a lot of scrutiny on the forecast and their projections for next year? Obviously, we've got election this November, and a lot of it will be caveated, I guess, around who gets into power on Capitol Hill. So, will they try and just be soft on the guidance until we get a bit more of a clue as to who's in charge and how this maybe Middle East thing plays out or doesn't by the end of the year?
Yeah, I mean, look, the reports are always backwards looking. So it's nice to see how Q3 did, but like you said, we're really looking for any clues on Q4, full year 2024, and of course 2025. And like you said, there's a lot of things that may change those expectations. So they're going to do their best modeling, either scenario for the presidential election. They're going to try to model, based on this port strike, Middle Eastern tensions, how all of that factors in. So you're right, we might get some sort of vague guidance, or the guidance might be in a very wide range, right? They might give EPS guidance that's a much wider range than they would typically give, because they're not quite sure. But a couple of signals I kind of look for about how companies are feeling, especially this year, is how much money are they spending? And I just wrote a piece the other day about buybacks. We're starting to see buybacks pick up again after being quite low in 2023. And, it's not the only metric to look at, but in 2023, companies were being pretty tight with their cash, right? We know they are flooded with cash, especially these large cap, mega cap names. They have a lot of cash, but they were really holding on to it. And that was because we weren't sure about the soft landing scenario here in the US. There was still talk about a potential recession. No one knew, inflation was still quite high. And so you really saw companies holding on. And now in 2024, that started to break open a little bit. Buybacks are back to some degree. By next year, analysts are saying buyback volume is going to hit 1 trillion. So I want to see what sort of buyback announcements there are. CapEx spending, are we spending on R&D? Where is the money going? Are mega cap tech names still spending into AI? Those are all positive signs that companies are feeling good about the state of the economy. They're willing to part with some of those dollars. And I think that should trickle into some of the guidance as well.
Okay. So, on the buyback principle, you're, I guess, I'm a fan or not a fan is not the right word, but some people get wary of buybacks when you start seeing a lot of these big corporates announcing their buybacks. You see it as a positive then, as long as they put that money to good use, as long as their ideas and their guidance on where that money's going is in development, is feeding back into the business and not into shareholders' back pockets?
Yeah, I think the best combination is a company that's doing both, right? Because buybacks can be a good thing for shareholders. They improve earnings per share just by reducing the number of shares outstanding. It's an artificial improvement, but it does sometimes improve. Well, it does improve earnings per share, although artificially. But we like to see companies that are both doing buybacks as well as investing in growth. And I think a great example of that is the mega tech names. The Magnificent Five, or how many ever we're down to now. But many of those are the largest buyers of their own stock, but they also invest heavily in product development, research and development, AI, all back into the company as well as into share repurchases. So yes, I absolutely agree. There's that age-old debate about whether or not buybacks are a good thing or a bad thing. A lot of folks would say, don't you have something better to spend your money on? Or it shows a lack of, creativity on how to use that money if you're just doing buybacks alone. But if you're doing buybacks, you're paying out dividends. That's obviously how shareholders get value out of the company, out of the shares they hold. But in addition, yes, we want to see companies that are investing back into the company itself.
Fair enough. I want to touch on the risks around for corporates at the moment, and that what we've seen. Obviously, we've mentioned it and touched upon it. We've got the Middle East crisis at the moment. We have this port workers strike as well. The Fed, will they go 25 or 50 again before year end? Will that help? Well, if Trump gets in, is that a better sign? Are there mounting risks going into this earnings season and beyond, really, that will worry investors, or do you think? It's a big question. I'll break it down. Where do you see the risks around in the corporate world at the moment?
Yeah, so it's dependent on sector, but as you pointed out, certainly the energy names will be talking about oil supplies and how that might be impacted. It's been a year since this started, since Israel was attacked, and oil supplies have been fine. We actually haven't seen any huge spikes in prices until Iran's airstrike in Israel this past weekend, and now we're starting to see worries and concerns about how that will impact supplies. I think I saw that OPEC does have a large spare amount of
Yeah.
crude that could step in. But, traders are worried about supply disruptions, in the Strait of Hormuz. And so although this hasn't really been an issue for the last year, it's certainly something that's coming into light that could add a significant, risk premium to oil.
Just
So you're going to,
on that front, sorry, on
yes,
that front, today we've seen options, and we're talking on Thursday, October the 3rd, but options have been seeing 100, 101 call spreads being put on at the moment. So I think there's a lot of that insurance premium is starting to ramp up, I think, rather than people just outright lifting the commodity. I think we're just seeing a few of these bigger companies just starting to hedge their bets on how much of an escalation we will see from this situation. Sorry, didn't mean to butt in. I just wanted to.
No, that's a great. And just this week alone, U.S. crude's gained about 5%. And like I said, prices have been relatively stable over the last year. So certainly something that we'll be looking for comments for in the Q3 reports. You mentioned the strike as well. We're into day 3 here. The repercussions of this could be enormous if it continues, much longer. Like I said, JP Morgan estimated it's costing us $5 billion a day. That's equivalent to 6% of U.S. annual GDP. We're heading into the holiday shopping season. It could be grim for retailers. I mean, I think most retailers, large, big box ones, have prepared. They learned after COVID with supply chain disruptions to stock up early. So I think the shelves are pretty well stocked. But if you look at some of the names that are being most impacted, that import most into the East Coast ports, it's names like Walmart, IKEA, Home Depot, Amazon, LG, so GM, autos and electronics. And so, it's going to lead to shipping delays. It's going to lead to price increases. And that's, we've just wrangled inflation here. Consumers are starting to feel a little bit better about costs, and to have those spike back up heading into what is the largest kind of shopping season of the year. I think the holiday shopping season accounts for 20% of all annual U.S. retail sales.
Wow.
It's not a great position for consumers who are already bargain driven. They're looking for value, and they're not going to be willing to shell out at higher prices. I mean, before this even happened, we were saying retailers are really going to have to offer deep discounts and big promotions this holiday season to lure shoppers in. Because although retail sales have been quite good, consumer sentiment is good. We know they are looking for a bargain, and they're holding on a little more, so they're not spending discretionary income as much as we typically do. So those are two things that we'll certainly be looking for. Like you said, U.S. presidential election, there's huge tax implications there depending on who wins. So I'm sure some analysts will be asking those questions on the calls, because some of these calls will be happening after the elections, because the peak season really begins like the last week of October, and you're still going to get a significant amount of reports into November after the election is held. So some of those calls will go from speculative to then we'll have an answer, and then analysts will actually be able to ask more pointed questions based on who actually won. So like you said, a whole lot going on, more than usual into an earnings season. So it just means you have to be paying extra attention to the commentary that these CEOs are given.
Understood. Well, I want to sort of wrap up then. We've gone over the risks, but can you see any highlights from this season? Sectorally, where do you think maybe some of the better performers are? And this is not a recommendation. This is not an ad to buy. Just in terms of your view, in terms of, and it's just a broad-based sectoral look. Where do you think some of the highlights? Where should we look in terms of some of the highlights?
Yeah, so we talk about leaders and laggards based on current estimates, and it's unfortunately it's the same old names. So tech is expected to be the big leader of profit growth once again. They're expected to be up about 15% year over year. NVIDIA, of course, the largest contributor there. They are still expected to grow 80+% on both the top and bottom line. And I saw just today the CEO, Jensen Huang, talking about Blackwell is in full production, and that demand for the new chip platform is, he said, insane. So you're seeing that stock is up 5% today. So it's going to be another NVIDIA quarter, I think. You've got that followed by communication services, expected to be up over 11%. Really, the two drivers there are Alphabet and Meta. And then healthcare kind of bringing up the rear there as the third largest leader. Pfizer, Eli Lilly, Moderna, all leading there. And then on the flip side, we've got three sectors expecting to show negative growth. That's led by energy. Of course, let's see how those conversations change. But currently for the third quarter, energy is expected to show a decrease of 18%. Exxon leads that decrease. And of course, it was falling oil prices throughout the quarter that contribute to that decrease. That's now changed for Q4. So certainly we'll be listening to Q4 guidance. And then the other two sectors that are lagging a little here is materials. I think about 2/3 of estimates in that sector have been ratcheted down by analysts. And then consumer discretionary, just about flat. I think they're down slightly, like down 0.3%. But again, as I just said, that's likely due to consumers holding back a little, pulling back, and retailers having to offer deeper discounts to lure them in. So those are the three lagging sectors that we'll be looking out for this quarter.
Perfect. Thank you very much. That's really good to know. And as I said, I really appreciate you, Christine, coming on to today's show and just giving us a bit more a heads up as to this oncoming season and what to look out for. Thank you. So I'd like to thank you again. I will put up your details
so much
on our social media platforms for people who want to try and see what Wall Street Horizon can do for them. Can get access to the website and everything you do, because I think you do some great work. I'd like to thank you
so much for having me.
Absolute pleasure. Honestly, I'd like to have you on again at some point, because I think this is sort of thing that our audience would love and do love to hear. So thank you very much. No problem. Thank you, Christine. Right, just to wrap up, then we'll put this out we'll put this out there on our social media platforms for you guys to absorb. As I said, we'll put up contact details for the Wall Street Horizon as well to see the great work they do. If you want to trial the LiveSquawk service, livesquawk.com, get a free trial and just see if this is the sort of service that will help you out. All right, thank you very much for listening. This has gone out on October, just for a time stamp. This is Thursday, October the 3rd. So just when you're listening, just bear that in mind whenever you take this show in, recording in. But thank you again for listening, and thank you to Christine, and have a good trading day. Thanks for tuning into the LiveSquawk podcast. Your edge in the market starts here. Subscribe now.